Hello there, welcome to another video on investing in stocks. A bit of a dreadful video today. Now for me, it's that time of year when I get to do my tax returns. Yes! Brilliant. Now investing in stocks is not all fun and games, and once a year you have to do your tax returns on the gains you've made from stocks or other investments, also called capital gains. Now I'm going to go through everything you need to know about taxes for most of the major countries that you, my viewers, are from, and I'm going to go into specifics into all of them. So it's going to be a quite lengthy video, and a couple of key things to keep in mind. Tax returns differ from country to country, from state to state. No country has the same rule about tax returns. They're all different. It's ridiculous. There are so much complicated rules and brackets out there, so I'll try to keep it simple. Now I'm no tax expert, this is not legal advice, and I highly recommend you check up with your local authorities in your country or your state or your city and make sure that you know what rules matter for you and what sort of tax returns you have to do personally. Now, broadly speaking, when it comes to taxes, you want to pay as little as possible and you want to delay the taxes as long as possible, because money you have to pay in taxes are not only money you're losing, it's also money that could have been invested in the stock market. So you lose out on the principal amount and on the potential gains on that money. Now the big difference is between long-term and short-term capital gains. They're always taxed differently. So if you hold an investment for less than a year, it's considered short-term capital gains. And they're mostly taxed at really high rates, sometimes even as much as the normal income tax rate. While long-term capital gains are almost always, in every country, every state, taxed way lower, as much as a third or a fourth of the short-term capital gain tax. Now, of course, before we start, capital gains are money you've realized from investments or been paid through dividend. So it's not your unrealized gain, it's only the realized portion. So you don't pay taxes before you actually sell your stocks. Very important to keep in mind. Now, of course, the capital gains I'm going to be talking about are stocks outside of tax shelters such as Roth, IRA, 401ks, ISAs, and various other accounts. Again, you need to check up with your local authorities and make sure you know what capital gains are taxable and what's not. Now, a small little disclaimer before I start the video. There are so many different rules in all the different countries, and I might have some numbers wrong, I might have some misinformation. Please feel free to correct me in the comments section, and yeah, just keep that in mind through the whole video. I'm not an expert, it's not legal advice, and make sure you check with your local authorities in your country or your state before making your tax returns. So starting off with the US, where short-term capital gains are taxed at the regular income rate, so it's added on top of your normal income, while long-term gains, if you're in the 10 to 15% tax bracket, so if you're a low earner, you pay 0% on your gains. If you're in the 15 or 25 to 35 bracket, I think you pay about 15%. If you're a high earner, so above 39.6% or above, you pay 20% on your capital gains. Still quite low compared to normal income tax though. Now in the United Kingdom, the UK, if you're in the regular income tax band, you pay 18%. If you pay more than the regular rate, you pay 28% on your capital gains. Over down under in Australia, short-term capital gains is taxed at regular income tax rates, while if you hold your investments for more than 1 year, so if they're long term, you get a 50% discount, which means only 50% of your realized gains are taxable. Now in Canada, they have by far the simplest solution, which I really like actually personally. In Canada, 50% of all capital gains are taxed. but they're taxed at the normal rate. So only half of your realized gains are taxed. I think this is brilliant, very simple. There's no brackets and everything. It's the same for everyone. So when it comes to tips and tricks on how to most efficiently do your tax returns, one of the most often used tactics is offsetting, where you offset your gains with your losses. So if you have, if you're going to realize some gains and you have also some losses in another investment, you might as well sell both and they will offset each other a little bit. So if you have $1,000 gain in one stock and then $200 loss in another stock, you only pay tax on $800. This is very often used. Of course, if you're a good investor, you're not going to have losses on any of your investments, so no offsetting for you. Now, another small tip, well, it's not a tip, it's actually something you have to do, is make sure you add your broker fees and deduct that from your gains. So whatever money you paid in management fees or transactional fees, or whatever fees you paid when buying or selling the stock, you need to take that off from the total sum you realized. So if you invest a lot of money and you have high fees, that can actually amount to a little bit of a difference. Another small thing is that some countries, at least in my country, Norway, there is something called an investment account or stock savings account. This is not like IRA or Roth or 401ks, but it is an account where you can realize a certain amount of gains and not pay any taxes on them, as long as you keep it in that account. So it's almost like a broker account, and as long as your money don't leave that account, you don't have to pay tax on your realized gains. Now, I will say again, check with your local authorities, tax authorities, and make sure you know the rules about tax on stocks, and make sure you check if there's any tax shelters, such as retirement accounts, savings accounts. If your employer, your company offers some sort of benefits, maybe if you're a military veteran or a senior or a junior, you might have some sort of discount. So make sure you check out if there's any way you can cut down on that tax bill. And then in very special cases, you might want to check up if there's any tax deferral program, write-off schemes, gift rules. If someone has died and you've inherited stocks, if someone has transferred you stocks for some other reasons, if you're investing in real estate, there are different rules. So make sure you really take your time to look into all the tax return rules. For me, I just did my tax returns. It took me 2 hours to fill in my whole portfolio because I own so many different stocks. And you need to have all sorts of information and dates and calculations and all sorts of stuff you need to have in your tax returns. Right, now that's going to be about it for tax returns. It can be very complicated, can be easy, but for a lot of first timers, if it's your first time filling out your tax returns for stocks, it can be quite overwhelming. Let me know if you have any questions. As always, have a good one, and I'll see you in my next video.